When it comes to an investment, do you have 5 days? Do you have 5 weeks, 5 years, even 50 years, guys? Today's video, we're going to be breaking down the long-term and the short-term investments. Really, the investment horizon is the big thing you have to look at, and knowing exactly what you're going to be investing in. If you're looking at the stock market, it is a lot longer term. If you're looking at CDs, things of that nature, it is really imperative that you think about this. And you can also have both things. You can have long-term investments, you can have short-term investments. And again, this is going to range from a couple days to a couple years, depending on exactly what you're looking to do. Now, when it comes to retirement, that is going to be, of course, a very long-term investment, depending on your age. But again, if you're looking for an investment goal of saving for something, or if you want to invest in, let's say, a home, the investment horizon might be a lot shorter, and that can make a big difference on how you invest. Number two, guys, we look at our financial goal, aligning investment strategies with specific goals. Long-term goals are associated with retirement, or short-term might be focused on more immediate needs or opportunities if you're looking to get into the market. Most of the time, when you look again at stocks, bonds, things of that nature, they are a much longer time horizon, which means if you're looking for short-term goals, it could be looking at high yield savings accounts and CDs. Like I said, it's something that you don't want to have a ton of volatility with, because if you put money into a short-term strategy, it goes down 30%. Now you could be in trouble financially because of that investment, not being able to hit those goals because of the decrease of the value of that asset. Number three, we look at the risk tolerance. This is, of course, something that is hugely different, guys, between the long-term and the short-term investment. Short-term is very sensitive to the market volatility because you are going to be in there for a very, very short amount of time, where when you look at a longer time frame, I'm thinking 5, 10 plus years. When you look at the market, guys, it yields about an 8%, 8 to 10% return on average. Now that, of course, is over a specific amount of time, but that is the average. So when you look at some of the short term that you're seeing, the 2%, the 3%, even the 5%, the market will over time yield a much better result, which could essentially be gone if you're not investing in the market. Now, most recently, a lot of people were saying they didn't want to invest in the market because the market was down. The market is not performing well. Now's the time, guys. You don't want to buy when the market is going up. You want to buy when the market is already down. It is really not pull your money out as it goes down. Keep the money in, put more money in. They always say when there's blood in the streets, you want to go ahead and be purchasing what is going on. Number four, we look at the asset allocation. This is kind of what we talked about. When you look at long-term investing, dividend portfolios, stocks, bonds, things of that nature, short-term, you're looking at more liquidity and more and less volatile, because again, you don't have the time that you're putting in the market. This means that cryptocurrencies are, in my opinion, a long-term investment. A lot of people do hold them, but there are a lot of people that do trade them on a very short-term really timeline, but that can be very, very scary, especially if, again, we see a major decline in the market like we have. Market timing is number five, guys. When you look at the market timing, this again is very important. Really living by the philosophy, it is not timing the market because that is near impossible, but it is the time in the market. When you look at a short-term investing strategy where investors aim to capitalize on short-term price movements, meaning that if you have a stock at 30, it goes to 32, you sell at 32, vice versa. If it goes down, then you can either short it or you can buy it when it goes down. A lot of people will play the market that way. Long-term investments adopt a buy and hold strategy. Personally, that is what I do because I don't have enough time to really invest into short-term market fluctuations. You know, buying essentially Bitcoin at 16, selling at 20, buying at 18, selling at 22, as it continues to fluctuate through the market. A lot of people do make a lot of money, but again, it is a lot of time that you're putting into a strategy like that. Number six, we look at the portfolio turnover. This is really when you're buying and selling assets within your portfolio. Short term will have a very high turnover rate, more transaction costs. This is very important, guys. If you're trading multiple times a day, like a lot of people do, especially with cryptocurrency, when you're doing the trades, when you're doing the buys and the sells, there are fees associated with every single transaction cost. Long-term investors like me, I put it in every 2 weeks, and that is it, guys. I do 2 buys per month. If there's 2 pay periods during the month, and that is it. So my transaction cost is much lower than a strategy of short-term investments with a lot of buys and sells. Always have to remember number 7 is the taxes, guys. Short-term investment capital gains rate is very depending on how you hold the investment. If it is a short-term hold, you are going to be subject to a higher tax rate for capital gains. If you hold it, I believe it is a year or greater, you're penalized or you pay less of a tax for an investment that you're actually holding for a considerable amount of time. Now, number 8 gets into the eighth wonder of the world, which is the compounding interest. Compounding interest over long-term investments is just incredible, guys. If you've ever done some of the compounding interest calculators, look at putting, let's say, $10,000, $50,000, $100,000 into an account, compound it for 30 years, you'll realize you have a couple $1,000,000, which is kind of crazy to think. Compounding returns can significantly increase wealth. In my opinion, this is the only way, probably one of the biggest ways, guys, and one of the only ways to generate sustainable wealth over an extended amount of time. Even if you're a real estate investment, taking some of the earnings, putting into somewhere with that compounding interest. If you're an investor, putting it into somewhere that is having returns. Even looking at the crypto market, guys, especially with Ethereum that you can stake, getting a return on your money that you already have invested is huge. Now, of course, you're going to completely mitigate this, or it is really less pronounced in short-term investing. If you're not holding it, you're not going to see the dividends. You're not going to see the compounding effect. Number 9, we look at monitoring and adjusting. This is one of the big things, guys. You have to look at market trends. You have to look at news. Long-term investments have a very hands-off approach. That is exactly what I do. Is I came up with a strategy, broke it down systematically, put money into that strategy, including some cryptocurrency, including a couple other things, including REITs. We have the VOO in there, of course. We have the SCHD, the Charles Schwab dividend fund. We have a couple in there that I've really picked out that I systematically put money into every 2 weeks, regardless of what is going, because it is a buy and hold strategy that I do have. Now, short-term investments, you have to stay really in touch with everything, guys. If there is something going on, such as a war, we could see the markets go up. If there's something detrimental to a company, you could see it bottom out. You could see, when we just seen Bed Bath & Beyond declare bankruptcy, they are out of the market. Number 10, we look at psychological factors. This is one of the biggest impacts that I see, guys, is when you look at the psychological factor. If the market's going down, people rush to sell, driving the market further down. Those are the best buying opportunities that I see. And again, looking at Warren Buffett, looking at a lot of the great investors, as the dollar cost averaging into something goes down. So if you have a stock that's at $100, it goes to 90, you buy a little bit. It goes to 80, you buy a little bit. It goes to 70, you buy a little bit. Then you actually dollar cost average into that position. Once it hits the bottom of the market and starts increasing, all of a sudden you're seeing a lot bigger gains because you've been buying it as it was going down, which again, that is the reason why I automate all of my investments, guys. When it's going over to the VOO, when it's going over to cryptocurrency, it is bought every 2 weeks, regardless of the price is up or down. I am really spending the time in the market, which I have another probably 16 years. I would say 16 to 20 years before retirement. Now I know I am retiring in probably about 6 more years. It is the plan, but it's not so much a retirement as I'm never going to work again in my life. But it's going to be looking at doing something like YouTube, more of a consistent, more of a full-time basis, which is going to supplement everything that we have within the investments. And the final one we look at, guys, is the liquidity needs. You have to be really sure when you're looking at the long term that it's not money. You're not putting your emergency fund in the market. You're not putting your savings accounts in the market. Short-term funds are meant to be accessible. That is the savings accounts. You're not locking them up for a long duration, which would be greater than a year. Long-term investing, you can afford to lock up your capital. It is money that you are not going to need for an extended amount of time, which could include a couple years. So I hope, guys, that this video really helped define the short-term and long-term investments in the strategies that go along with it. So let me know in the comments what you guys think, and I'll catch you in the next video.